If you're watching this with $0 to invest, I want you to know something. You're not behind. You're at the starting line. And in 2026, the starting line has never been more powerful because you can learn faster, earn faster, and invest faster than any generation before you. Hi, my name is Matt, and in this video, we will be talking about investing from $0 in 2026, the complete guide. And real quick, if you like practical money videos with no fluff, hit subscribe. I post simple, step-by-step strategies you can actually use. Alright, let's get into it. Today I'm going to show you exactly how to go from $0 invested to building real wealth, starting with literally nothing. We're going to cover the order of operations, the tools, the accounts, the mindset, and the mistakes to avoid, and I'm going to make this beginner friendly but still smart enough that if you already invest, you'll probably pick up a few upgrades too. Here's the truth, investing is not about being a genius. Investing is about having a system. If you build the system once, you can run it for decades. So my goal is that by the end of this video, you have a simple system you can follow starting today. We're going to move in stages. First, what to do when you have nothing, then how to get your first $100 invested, then how to build consistency to $1,000 and beyond, and finally how to scale that into real wealth over time. By the end, you'll have a full roadmap you can copy. Let's start with the most important idea, and it's the part most people skip. When you have $0, your best investment is cash flow. People want stock picks, they want what should I buy, and I get it. But if you have $0 to invest, your real problem is not investing. Your real problem is that you have no surplus money. Cash flow comes from one of two things: spending less than you earn or earning more than you spend. That's it. That's the whole game. So here's the checklist I want you to follow in 2026 if you're starting from $0. First, track your money for 7 days. Not forever, not a perfect budget you'll never use. Just track everything for 1 week. Use your notes app, a spreadsheet, or a budgeting app. The point is awareness. When you know where your money goes, you automatically get better with money. Next, find your leak. Most people don't have one big problem, they have 5 small ones: DoorDash, random Amazon orders, subscriptions, late fees, just this one's purchases. Your goal is to find the easiest leak to plug, not the most painful one, the easiest one. Then create a minimum investing margin. This is the amount you can invest every week no matter what. For some people it's $5, for some it's $25, for some it's $100. The number doesn't matter, the habit matters. Pick an amount that feels almost too easy, because in the beginning you're not trying to get rich, you're trying to become an investor. And one more foundational step before you start investing heavily: build a starter emergency buffer. I'm not saying you need a perfect emergency fund before you invest, but if you're at $0 and one surprise expense wipes you out, you're going to keep pulling money back out of investments. So your first goal is a mini buffer, somewhere between $300 and $1,000 in a high-yield savings account, enough so your car tire doesn't destroy your progress. If you're thinking, Matt, that's not investing, I agree. But it is the foundation that makes investing actually stick. Now, once you can create even a tiny investing margin, here's how you get your first $100 invested. Your first $100 invested is a psychological milestone. It proves you can do it. And in 2026, you can invest with fractional shares, automatic deposits, and low fees, so the mechanics are easier than ever. First, you need a brokerage. You need a place to invest. For most beginners, you want no account minimums, fractional shares, automatic recurring investments, a clean interface, and the ability to buy low-cost index funds or ETFs. I'm not here to marry you to a specific app. The platform matters less than the behavior. Pick a reputable brokerage, open an account, and keep it simple. Second, choose the right account type, because this is where people mess up. The account you use matters almost as much as what you invest in. Here's the simple rule: if you have earned income, your first investing destination is usually a Roth IRA. Why? Because a Roth IRA lets your money grow tax-free and you can withdraw your contributions later if you absolutely had to. It's one of the best wealth-building tools for beginners. Now, there's one exception that often comes before the Roth IRA. If your job offers a 401k match, that's priority number 1. A match is free money. If your employer matches 3% and you contribute 3%, you just got a 100% return instantly. You will not beat that with stock picking. So the typical order looks like this: get the 401k match, then fund the Roth IRA, then go back to the 401k, or use a taxable brokerage account. And if you're self-employed, you still have retirement options too. Even if you don't know every account name, don't overcomplicate it. Start with an IRA if you can. Third, invest in something boring on purpose. You are not trying to beat the market with your first $100. You are trying to own the market. The simplest beginner investment is a broad, low-cost index fund or ETF that tracks the total stock market or a large chunk of it. The key features are broad diversification, low expense ratios, a long track record, and something that's easy to hold for decades. Could you add some bonds? Sure, later. Could you add international? Sure, later. But the mistake beginners make is trying to build a perfect portfolio instead of building a consistent one. So your first $100 goes into a broad market index fund or ETF. Set it and forget it. Fourth, turn on automation immediately. Automation is the cheat code. Set a recurring deposit that matches your investing margin. If you said $10 a week, set $10 a week. If you said $25 every paycheck, set $25 every paycheck. The amount is less important than the fact that it happens without you needing motivation. Because motivation is unreliable. Systems are reliable. Now you've invested $100? Great. But the real magic is building consistency to $1,000 and beyond. Once you're in that phase, you want to increase your investing margin slowly. I don't want you to go from $10 a week to $200 a week overnight. That's how people quit. Instead, use a raise rule. Every time you get a raise, a bonus, or you pay off a debt, increase your investing by a small percentage. Even an extra $5 a week matters. Now we have to talk about debt because this is real life. Some people argue about investing while in debt, so here's my take. If you have high interest credit card debt, that is an emergency. Pay that off aggressively. A guaranteed 20% interest charge is worse than almost any investment return you're hoping for. But here's the nuance. You can still invest a tiny amount while paying off debt just to keep the habit alive. Even $5 a week, the habit is the point. Your long-term success isn't just math, it's behavior. Next, I want you to build a simple 3-bucket system. Bucket 1 is safety money. That's your emergency fund in a high-yield savings account. Eventually, the goal is 3 to 6 months of expenses, but start with your mini buffer and build from there. Bucket 2 is growth money. That's your long-term investing in retirement accounts and broad index funds. This is the wealth builder. Bucket 3 is fun money. Yes, fun money. If you don't plan for enjoyment, you'll rebel and sabotage your plan. Give yourself a small, guilt-free amount. The point is sustainability. When people fail with money, it's usually because they tried to be perfect. We're going for consistent. Now you only need to learn a few key concepts to avoid dumb mistakes. You don't need to become an economist. You need to understand compounding, diversification, risk, and time horizon. Small amounts grow into big amounts over time. Don't bet your future on one stock. Stocks go down sometimes, and that's normal. And money you need soon shouldn't be in volatile investments. If you understand those 4 things, you're already ahead of most people. Now let's talk about what to actually buy as your portfolio grows, because this is where people spiral. I'm going to give you 3 simple starter options. This is not personalized financial advice. This is a beginner framework. Option 1 is the one fund approach. One broad total market index fund or ETF. This is the simplest and simple wins. Option 2 is a 2 fund approach, something like 80% total stock market and 20% total bond market. This adds stability if you can't handle volatility. Option 3 is a 3 fund approach, something like 60% total stock market, 20% international stocks, and 20% total bond market. This is still simple but more globally diversified. Which one should you choose? If you're young, investing for decades, and you can handle the ups and downs, the simplest approach can be fine. If volatility makes you panic sell, add bonds. The best portfolio is the one you can hold during a crash. And yes, crashes will happen. That's part of investing. So let's talk about how to invest when the market feels scary, because the emotional side is where people actually lose money. In 2026, you're going to see headlines like recession fears, market crash, bubble. This is the best time to buy, and it's going to make you feel like you need to do something. But investing is not like driving a car where constant input keeps you safe. Investing is more like planting a tree. The best thing you can do most of the time is nothing. Here's what to do when markets drop. First, don't check your portfolio every day. Checking daily turns investing into entertainment, and entertainment makes you emotional. Second, keep investing on schedule. If you invest automatically, market drops mean you're buying shares on sale. Third, zoom out. If your time horizon is 10, 20, 30 years, short-term drops are noise. If you can master this, you will outperform most people, not because you're smarter, but because you're calmer. Now I want to lay out a few rules that keep investing simple and smart. Rule 1, never invest money you need in the next 3 years. If you need it soon, keep it safe. A high-yield savings account, short-term treasuries, whatever fits your comfort. Stocks are for long-time horizons. Rule 2, keep fees low. Fees look small, but they compound in the wrong direction. A high expense ratio is a permanent drag on your returns. Low-cost index funds exist for a reason. Use them. Rule 3, don't confuse being busy with being productive. Trading a lot feels productive, it's usually just expensive. Long-term investing is boring, and that's the point. Rule 4, build your investing plan before you need it. When you're calm, write down your rules. What you invest in, how much you invest, when you invest, and how often you adjust things. Then when the market gets wild, you follow the plan instead of your feelings. Rule 5, focus on what you can control. You cannot control the market. You can control your savings rate, your fees, your diversification, and your time in the market. Now the question I always get is, Matt, what about individual stocks? So let's be real about it. My philosophy is simple. Build your boring base first. Then if you want, you can add a small side bucket for higher risk. If you love tech stocks or you want to own a few companies you believe in, cool, but do it with a cap. For beginners, that cap might be 5% to 10% of your total investing. That way, if you're wrong, you don't blow up your future. Same thing with crypto. If you're going to do it, keep it small, understand the volatility, and don't invest rent money. Your core should still be diversified index funds. And please avoid the trap of this one thing will change my life. The thing that changes your life is consistency, not a miracle trade. Now remember, if you start from $0, the fastest way to accelerate is increasing your income. Because once you have the basics set up, investing more is mostly about having more surplus money to invest. Here are the best beginner moves in 2026. 1. Ask for a raise, but do it strategically. Document wins, bring numbers. Make it easy for your manager to say yes. 2. Upgrade one skill that pays. Pick a skill that's in demand in your industry. Sales, analytics, project management, coding, design, operations, whatever fits. One skill upgrade can increase your income permanently. 3. Start a simple side income stream. I'm not saying start a complicated business. I mean something realistic. Freelance, reselling, tutoring, delivery, pet sitting, content creation, anything that turns time into money while you build skills. 4. Cut one major expense temporarily. If you can reduce housing costs, transportation costs, or lifestyle inflation for a year, you can invest dramatically more. And the key is this: don't just earn more. Lock it into investing with automation. When your income goes up, your investing should go up automatically. That's how people build wealth quietly. Now let's talk taxes, the most boring way to get richer. You don't need to be a tax expert, but you should understand the basics. Retirement accounts can give you tax advantages. A Roth IRA is funded with after-tax money, but growth and qualified withdrawals can be tax-free. Traditional retirement accounts can reduce taxable income now, but you pay taxes later. A taxable brokerage account has more flexibility, but you might owe taxes on dividends and capital gains. That's not bad, it's just the trade-off for flexibility. The simple takeaway is this: max out the free money and tax advantages before you pile into a regular brokerage. And also, don't panic about taxes. The goal is still to make money. Paying taxes usually means you made gains. Now I want to rapid fire the common beginner mistakes that keep people at $0, because if you avoid these, you're already winning. 1. Waiting for the perfect time. There is no perfect time. Start now with what you have. 2. Starting too complicated. If you need a 17-tab spreadsheet to invest $20 a week, you will quit. Keep it simple. 3. Panic selling. If you sell every time the market drops, you lock in losses. Investing requires patience. 4. Chasing hype. If something is trending and everyone is talking about it, it's probably already priced in. Build your base first. 5. Not having a cash buffer. If every surprise expense forces you to sell investments, you'll never build momentum. That mini emergency fund matters. 6. Comparing your chapter 1 to someone else's chapter 20. You start where you start. Your job is to improve from your baseline. Now let's put everything into one clean step-by-step roadmap you can actually follow. In week 1, track spending for 7 days, plug the easiest leak, and choose an investing margin even if it's $5. In week 2, build your mini emergency buffer, open a high-yield savings account, and set an automatic transfer to it. In week 3, open your investing account. If you have a 401k match, contribute enough to get the match. If not, open a Roth IRA if you have earned income. In week 4, invest your first $50 to $100 into a broad market index fund or ETF and turn on recurring investing. From month 2 to month 6, increase investing slowly using your raise rule. Pay down high interest debt aggressively and build your emergency fund toward 1 month of expenses. From month 6 to month 12, aim for $1,000 invested, keep it boring, and focus on income growth. In year 2 and beyond, build to 3 to 6 months of emergency fund, increase retirement contributions, consider adding international and bonds if you want more diversification, and keep investing automatically. If you follow that plan, you will not be investing from zero for long. Now, one last thing people always want to know is how long it takes to see results, and this is the part people don't like. Investing is slow at first. Your first $1,000 can feel like it takes forever. Your first $10,000 can feel like a grind, but then something happens. Compounding starts to work. Once you have momentum, your money starts doing some of the heavy lifting, and the bigger your portfolio gets, the more your contributions and growth stack up. The trick is getting through the early phase without quitting. That's why we focus so much on automation, consistency, and keeping it simple. Before we wrap up, I want to cover a few boring but important setup moves that make this easy. First, put your accounts on autopilot, then hide them. Once you have recurring contributions set, remove the brokerage app from your home screen, or at least turn off notifications. You don't need a push alert every time the market sneezes. Your job is to keep depositing, not to micromanage the day-to-day price. Second, use paycheck investing, not leftover investing. If you invest whatever is left at the end of the month, you'll usually invest nothing. Flip it. Treat investing like a bill that gets paid first. Even if it's small, it comes out automatically when your paycheck hits. Third, protect yourself with simple security habits. Enable two-factor authentication on your brokerage and bank accounts. Use a password manager if you can. And don't invest on sketchy Wi-Fi networks. It's not to scare you, it's just basic digital hygiene in 2026. Fourth, understand recurring investing without overthinking it. Investing a fixed amount on a schedule means sometimes you buy high, sometimes you buy low, and over time you average in. The point is, it removes the pressure to time the market. Timing feels smart, but consistency is what actually works for most people. Fifth, rebalancing only matters if you need it. If you have one fund, there's nothing to rebalance. If you have a few funds, rebalancing just means bringing your percentages back to your target. You don't need to do this every week. Once or twice a year is fine for most beginners, and some people do it even less. The bigger risk is you messing with things too often. Sixth, don't ignore inflation, but don't obsess over it either. Inflation is basically the cost of doing nothing with your money. That's why we invest. Keeping an emergency fund is still smart, but anything beyond what you need for safety should have a job, either investing for growth or paying down high interest debt. Seventh, know your why, because your why will carry you through drops. Write down what you're investing for. Freedom, stability, helping family, retiring early, buying time. When the market is down and your portfolio looks ugly, your why is what stops you from panic selling. If you do these boring setup steps, you'll be amazed how easy investing becomes. You won't feel like you're constantly making decisions. You'll feel like you're following a plan. One more quick tip, keep your investing money separate from your spending money. A lot of people open a second checking account or a dedicated savings account just for bills. When your bills are covered and your investing transfers are automated, whatever is left is discretionary. That separation reduces stress and prevents overspending, which matters when you're starting from $0. So if you're starting from $0 in 2026, here's the main message. You don't need a lot of money to start. You need a plan. Build cash flow, create a small buffer, automate investing, buy diversified low-cost funds, and keep going when the market gets noisy. The people who win are not the people who predict the future. They're the people who keep investing through every version of the future. Start with your first $5, your first $25, your first $100, and then let time and consistency do what they do best. Thanks for watching, and I'll see you in the next video.